Good morning, everyone. I'm Tia Marsili, Director of Trusts at the Arc of Northern Virginia, and welcome to our 2022 Meet the Trustee, where we've invited our partners at Key Private Bank to speak to you about their role in our collaborative special needs trust program. And we have a couple of house rules, and basically it's stay muted. And we're going to ask you to put your questions in the chat box as opposed to the Q&A, and then we'll read the questions. The format will be, first I'm going to have our new account manager, Rob Hallback, introduce himself, and then we're going to go through KeyBank, and everybody will introduce themselves and talk about what they do and hand it off to their next colleague. So that's, you guys can, call it and now to you, Cindy, right? We'll do something like that. And we have an evening session, so I hope you're able to join in. And I can tell you that the Arc of Northern Virginia has had our Special Needs Trust program since 1999. Although we're the Arc of Northern Virginia, we serve the entire Commonwealth of Virginia, the state of Maryland, and Washington, D.C. We do have clients in other states. Excuse me, we're not trying to go national. When people move, we try to accommodate them as best as possible. There are another 20 or so ARC chapters throughout the United States that also manage special needs trust programs. So sometimes people may want to transfer to the ARC in their state if they move, or stay with the Arc of Northern Virginia. So there's options. The Arc of Northern Virginia offers one free consultation. Either Ashley Welch or I will provide 50-minute consultations to people. And then after that, it's a fee for service for those consultations, since there are so many people that are looking for so much information. We have what are called Trust Talk Tuesdays. So 2 Tuesdays, let me just go in here. There we go. 2 Tuesdays a month. Either Ashley or I facilitate what I call a round table. So we talk about special needs trust, but we talk about anything else that's disability related as people have questions, whether it's Medicaid waivers or Social Security benefits, housing vouchers, housing grants, food assistance, energy assistance, et cetera. And special needs trust, obviously, and letters of intent and estate planning. And we're able to refer you to other professionals who can assist you in those areas. We have something called First Friday's Futures Planning. So on the first Friday of every month, unless there's a holiday on a Monday, we have a topic and invite guest speakers. Those topics are related to the questions, the most frequently asked questions that come up in our consultations. Those are all recorded and put on our website. The Trust Talk Tuesdays, and then the other things that I'm going to talk about, we do not record because of people ask a lot of personal questions and share a lot of personal information. We have, thank goodness, it's Financial Fitness Friday. So the third Friday of the month, we switch between financial planning, special needs trusts, and Social Security benefits, Social Security basics, and bring in an expert. So those rotate quarterly. We just talked about financial planning in October with a financial planner, and next month this month it's on special needs trust. I'm trying to remember. So those are the third Fridays of the month, either financial planning, special needs trust, or Social Security benefits. All of these badges that you see on the side of the screen, those represent the different topics that I just mentioned, and they all start at 10 a.m. and run till 11:30 a.m. And you RSVP at thearcofnovatrust.org/events. Briefly, as mentioned, I'm the Director of Trust at the Arc of Northern Virginia. I started on September 6th of 2006. My position, the position Director of Trust, was created in August of 2009. And since then, I've been overseeing and growing the Special Needs Trust program at the Arc of Northern Virginia. And today, I'd like to introduce Rob Hallback. Rob is our account manager. He's our new account manager at the ARC of Northern Virginia. And I am going to see if I can unspotlight myself and spotlight him, because I did that without knowing how to get out of the spotlight option. I'm going to go back to full screen and gallery. There we go. So Rob, where'd you go? There's Rob. So Rob,
Good morning. My name is Rob Hallbeck. I started with the ARC of Northern Virginia about 2 weeks ago. I've spent the last 25 plus years in corporate America as a financial planning and analysis support for software companies as well as telecom, and also have a special needs daughter who I've been supporting primarily for the last couple of years, and wanted to help out here and help others. So happy to be part of the team, and look forward to working with all of you. You can reach me if you're still with Trini's number. That's the number I've inherited. So you can reach me at Trini's number, extension 119.
Thank you, Rob. Cindy.
Good morning, everybody. My name is Cindy McDonald, and I am the National Director of Philanthropic Advice here at KeyBank. And we work closely with Tia and her team to help deliver the best of our ability to all different types of services. And we act as trustee, and we partner and collaborate with Tia and her incredible team at the ARC to help provide services to the individuals and beneficiaries of the ARC. This process actually started, we just had our 6th anniversary with Tia and her team back in September. So happy to say, back early in 2016, Tia and her team took on the endeavor of trying to find a new partner, one to act as trustee, financial advisor, as well as just helping deliver the services that you receive on a daily basis. So we were happy to be part of that process, and partnered in September. And it's been growing and just having a lot of fun with it as well as we've gone through the years, having these types of meetings such as Meet the Trustee. And then tomorrow on Friday, we also have a real estate presentation to talk about how, the thoughts around real estate and how to possibly add it to a special needs trust, or what to do with it, questions around it, super high level. But these are the types of services that we can bring to the organization. And again, our partnership with Tia and her team. So that's myself, and I'd like to pass it off to Vince, who's a wonderful part of the team and a wonderful relationship manager for the ARC.
Thank you, Cindy, and good morning, everyone. And Tia, as always, thank you very much for allowing us the time on the call this morning with all the participants that are joining us, and to eventually get out there on the World Wide Web. But by way of introduction, my name is Vincent Miles. I am the Senior Relationship Manager here on the team. I'm responsible for the overall delivery of all of our pool trust services to the ARC of Northern Virginia. And I am Tia's primary point of contact for just about anything that goes on within the relationship. And it's my job to make sure that all our services are delivered to Tia and the team and the participants in a timely manner, that we're making sure that we're partnering together quite well to make sure that we're taking care of the needs of the many. Also, too, responsible, we'll get to the person that is responsible for managing the investments, but again, I oversee that as well with Peter Marici. I've been with Key Private Bank for 6 years now. The first 17 years of my career was spent with another financial institution in a similar capacity, working with institutions, nonprofits, high net worth individuals, and delivering all the services that go along with that. And I've been on the ARC of Northern Virginia now. I believe I'm going on my 5th year as being fortunate enough to being able to work with Tia and her team. So looking forward to a great hour. We're open for any questions that are out there. And I'm going to flip it over to Peter Marici at this point.
Thanks, Vince. Good morning, everyone. Again, my name is Peter Marici. I am the portfolio strategist for the ARC of Nova's account, which means I manage all the pool trusts. I've been with Key since 2013, and I have been in investments since 2005. I was actually with the same firm that Vince mentioned or alluded to. I'm a CPA and also a certified financial planner, and I believe I've been on the Arc of Nova pretty much right from the beginning of the relationship. So I'm here to answer any questions you may have. I wouldn't think you wouldn't have any given the year we've had this year, but you may have one or two. So I'd be happy to ask and answer any questions you may have. And I'll pass this to my colleague, Linda.
Hello, I'm Linda Hall, and I am a senior tax officer here at KeyBank. I have been with KeyBank for 25 years in this same position, and actually have been preparing taxes for over 34 years. 7 years within public accounting in various areas, but specializing in fiduciary tax for the last 27. Again, 25 here at Key. Basically, we just oversee the process to deliver any tax documents out on an annual basis. Those come out sometime around March. You will start receiving tax documents, and that's pretty much my role. With that, I will pass that. I think it's January's on here, right? So I will pass to January Phillips.
Thank you. I'm trying to find January's. She was on here. Where'd you go, January?
I just turned on my camera.
There you are. Okay, good.
Good morning. How is everyone? I'm January Phillips. I work with Key Private Bank Trust Real Estate. I've been doing this for a little over 6 years now. I work closely with Cindy and Vince's team. I do everything from reviewing the real estate that you want to bring in. We assist in purchasing and sales, as well as managing everything associated with real estate held in special needs trust or supplemental needs trust. That is one of my areas of expertise that I deal with. So if anybody has any questions or anything, please feel free to share them. Look forward to hearing from everybody.
Thank you, January. So I'm going to try something really snazzy to see if I can do add spotlight and just get all of my guys here on the screen. Linda, I'm going to bring you up there too. And
showing your savviness, Tia.
I tell you, this is early in the morning for me. I don't know. If anybody, any of our guests have any non-ARC, non-KeyBank guests have questions, pop them in the chat right now while I add spotlights to everybody's name. So I have Peter, I have Cindy, I have Vince. Who am I missing from Key? Anybody on the screen right now?
Nope, you've got the team.
That's all of us, Tia.
Let me see if I need to, I don't even know how to
travel in packs.
Pardon me?
We travel in packs.
Exactly. That's a good thing. I keep telling people this is your opportunity to meet the people we work with. So I'll keep my picture off the screen this morning since you are our guests. And what I thought I could do, again, attendees, pop your questions in the chat. But what I guess I will ask some questions, and as people pop in, I'll let Kathy, for example, know. Kathy, we are recording this since we had a issue with the link, and so we're going to record this so people can have access to it. I have spotlit the KeyBank personnel or staff, or our partners, I guess is the real word to use. And any questions you may have, just pop them in the chat. And I see a question came up already. And so Cindy, do you want to read that one? I'll let you guys run the chat.
Yeah, I can read them, Cindy, if you'd like.
You want to read it?
You guys can,
we'll let Vince be the moderator on the questions.
Yeah, because I know, Tia, you have to take notes or do whatever. Yeah, so the first question is from Wes. If a parent or family member wants to gift to an existing third-party trust, does the annual gift tax exemption rules apply, or do they need to fill out a gift tax return?
So I'm going to take a stab at that, and Linda's going to correct me. But so the annual gift tax exclusion does not require a gift tax return. So it's an exclusion amount up to, I think it's 16,000 now in this year, 2022. So, but if they were to go past their exclusion amount, and you must connect with your CPA or your accountant to confirm this, then you'd have to fill out a gift tax return. But if you're just utilizing your annual gift tax exemption, there's no reason to complete a gift tax return. Linda, did I get that? See, this is why I surround myself with very smart people.
Thumbs up, 2 thumbs up. All right. And at this time, I don't see any other questions in the chat. So feel free to put more questions in the chat for us. Oh, we just got another one. Okay. Kathy just joined the chat. And she wants to know, has she missed any questions regarding leaving money to a trust?
I meant leaving an IRA. I'm sorry. It took me a half hour to get in. I had the wrong link.
Okay, so leaving an IRA to the trust. Kathy, is a specific question that you have around that? Or?
Yeah, what happens? So I've been told by Tia many times, and I've heard, you must leave it to the remainder to a human. So what happens if you don't know of a human that you want to leave it to in 50 years when Sam dies?
So I'm going to jump in and I'm not going to make assumptions, but I'm going to talk high level about the conversations I've had regarding leaving IRA assets. So you're looking at leaving IRA assets to an individual with disabilities, correct?
Yes.
Okay. So you obviously don't want to do that, name that person individually. So Sam Smith, I'll just use an example, as the beneficiary IRA, because that way you're leaving it directly to him, it's counted as income, and you could possibly, do away with all his benefits. What you want to do is you want to actually name the third party pool trust as the beneficiary, because what's going to happen there is that's considered an accumulation trust. So what happens is if he is the sole beneficiary, or his trust is the sole beneficiary of the IRA, when you pass, that's going to roll into an inherited IRA, still remain in that IRA wrapper. And then he is the measuring life because he's the only individual that's the beneficiary of his third party pooled special needs trust. So he's the measuring life. And I know this gets really complicated. That's why I always say, I'll have the conversation, but really go back to your CPA and just, kick the tires and make sure what we're saying is what they believe as well. But
so a CPA or my attorney, who do I talk to?
When it comes to these types of rules around your IRA, I would start with your accountant, Linda, right? Start with the accountant because they know the tax rules.
And you also should talk to your IRA provider and understand the rules that are involved there. But the real key is, how is the trust structured? Most cases you have it set up for the special needs individual, and upon their passing, it'll usually go to siblings or so forth. If there are no siblings and you're leaving it to a charity, that's when it can become more complicated because the trust may not meet the see-through rules in order to stretch that over the special needs person's lifetime. When it's the siblings who will inherit on the special needs person's passing, they're individuals, you can then stretch it. But if it's being left to a charity, then it kind of defaults back to that 10-year payout period that because the trust will not meet the see-through looks. So every situation has to be looked at individually to see if it meets the requirements.
I asked Tia to comment on that. How is the trust? I'm not understanding how the trust is written then or set up.
So Cindy or Vince, can you talk to what you do whenever an IRA is directed to the third party special needs trust?
So at this point, what we're hoping that has taken place is you've had the conversation with Tia, you've established a third party trust with the pool for the benefit of your child. So that piece is like he's the only beneficiary of his piece of the pool, because they each have their individual EIM with when you get into the third party pools. So that will that will clarify and meet the one need around being the only beneficiary in the measuring life. So it's really important that as you're rolling through doing your estate plan and organizing your IRA assets, that you meet with Tia and establish that third party pool so that it can be the beneficiary of your IRA.
Right.
Does
I
that help?
believe the agreements also include the remainder beneficiary and other things within that joinder agreement. And that's what has got to be assessed and looked at for the planning around the IRAs.
Okay, thank you.
So Kathy, what was there more that you'd like me to
Well,
add?
I'm just really confused. I guess when I did this wasn't the rule when I created the trust. Is that true?
Correct.
Yeah.
So now, what do I need to do, Tia, to update my trust? Get in touch with you, I guess, or
yes. So you will, or Ashley Welch. So our client manager or assistant director, Evelyn Goose, coming back, yay, from maternity leave toward the end of November of 2022 for recording purposes. I'm announcing that date. Yeah, so we'll have to go back. So our master agreement allows for the grantors to change the remainder beneficiaries. And so we'll have to look at the remainder beneficiaries, because hypothetically you may have selected nonprofits and no humans as the final remainder beneficiaries. So that, and I don't know, and I guess this is where maybe an attorney would be helpful, and or somebody here from KeyBank, to say, well, if there is nobody else, like my child is last man standing. And so whenever my child passes and all these assets are in a special needs trust, and I really wanted to direct them to nonprofits and not a person, how would you recommend, or can you counsel me on what final remainder beneficiary to name to ensure that any remainder in the special needs trust does go to the nonprofits I've selected? And I think that's really your second question, Kathy.
So in other words, I need to work with Stephen and you again.
Stephen and I for sure. Yeah. And then if anybody here at KeyBank has any good, like for example, okay, so here's what I would do. Personally, this is Tia Marsili with my mom hat on. I would probably say, maybe ask an attorney or a very well-trusted friend to be the final remainder beneficiary, and explicitly, and I don't know how we'll do this, we'll have to figure this out because this has just popped into my head, right? So no thought given to this at all. How do we guarantee that that person or that person with a title is legally bound to then disperse the assets to the nonprofits that I wish to contribute to?
The only thing I'll say to you is, like, definitely, Kathy, I would work with your attorney on that, because for what the scenario that Tia just explained, that's a matter of trust, because there's no legal obligations once those funds are in that person's hands. You're leaving it to them, and you're hoping that they continue on with maybe a letter of intent out to like 4 or 5 different charities. So I would definitely connect with your attorney, because Tia, I like the idea, but it's a matter of trust, because yeah, it's totally a matter of trust. So you're literally saying, I will leave all the funds to my friend, thinking that they're going to take the funds upon my passing and disperse out per my wishes. And what you're trying to do is alleviate the new laws that are in place, saying that if you have a charity named in there, you have to do the 10-year payout, as opposed to utilizing the fact that the child's individual disabilities and can utilize this judge. So it gets very dicey and very tricky.
Yeah.
And that's why we look at this each and every year, because tax law changes. It's a fluid thing.
Okay, so I don't really, I worry about if I leave it to somebody that maybe they're going to pass, who knows what's going to happen. I'd rather leave the money. So if we left it to, what you're saying is if we left it to the pooled trust, it would be distributed as we wanted?
No.
So, no.
Right.
No, we're saying you have to leave it to a human. The final remainder beneficiary needs to be a human. So if you delegated Steve as your attorney and entrusted him with that, because he's a few decades younger than both you and I, and the hopes are that he'll, I don't know if the hope is that he'll outlive us, but in this scenario, it certainly is. Then if you left it to somebody like Steve, attorney at law, hoping that he would fulfill your wish to distribute it to the different charities you've selected. But as
So when
Cindy's
Kath-
saying, you have
Yeah,
to
no,
trust
no.
that person.
Yeah, and Kathy, I'll just say, so I'll go back and I'll put on the old hat of a fiduciary and a trust officer. So this is why we talk to clients and we say each and every year, look at your estate plan. Make sure that all the people that you have named out in your estate plan are still valid, still alive. That, you know, check the boxes annually, just like a checkup. You go for a physical every year, do the physical on your estate plan. Check it out, check the boxes, and make sure the people that you have named are still willing to serve, still able to serve, still on the same page as you, and alive.
That's what I've been doing. And okay, so can I ask another question, or if somebody else is waiting?
No,
There's
keep
no
going.
questions. Yeah, there's no questions in the chat box.
point.
Okay. So actually then the safest thing to do would be to take whatever assets we have that are not in an IRA and put those in Sam's trust. And then we could leave that to charities.
The IRA, you mean direct those to charities?
But if it's not in an IRA,
direct it to the trust. Yes, that's the.
It's better maybe just to leave our cash, you know, other assets to the trust.
And I wouldn't use the word better. I'd say that's the easier route to take, right? And it truly depends on, with anybody and everybody listening in or watching this, it depends on your assets and resources, right? Because somebody may only have retirement accounts. And correct me, Linda, Cindy, Vince, Peter, Jan, when we talk about IRAs, are we talking about under the Secures Act? Is it secure or secures? Is there an S at the end of that or not? No, Secure Act. Thank you. Secure. Under the Secure Act, is it any retirement account? IRA, 403B, 401k, thrift savings plan. Is it any retirement account that we're referring to here, or is it specific to IRAs?
I think it's qualified assets.
All qualified plans,
but you, like to Linda's point before, I think the individuals, so if you're into thrift plans 403B, you really have to get into the actual document itself, the provider, and have the conversation with the actual provider. It's easy to have the conversation and talk about traditional plain old IRAs because they are plain vanilla and super easy. But when you get into the more complex, really make sure that you're talking to your actual provider that's managing the IRA, those qualified assets right now, before you go ahead and make any decisions. And how it could be different.
Right, and a plan could be very different. I can tell you from a personal standpoint, my husband inherited from his brother's OPERS. We were requesting to name a beneficiary, and they had very steadfast rules at that point. It had to be my husband's estate. We could not name any additional beneficiaries. So we're taking steps in place to do a rollover to another plan where we can name a beneficiary. So knowing what that plan is and asking those questions can prepare yourself and be able to see what restrictions the actual plan has. And that was a personal, I mean, you know, from our personal standpoint, some planning we were trying to do on our side that we ran into. With some restrictions.
Life experiences help though, so that's good, Linda.
Yes. Yeah, I knew I didn't want it to go to the estate because I didn't want to deal with that. So, like in this case, in this case, you might have restrictions in the plan that will not allow you to name the beneficiary, the trust as a beneficiary. So.
Right. Okay. And so currently all of our IRAs, which is most of our assets, have our May family trust as the beneficiary after my husband and I pass. And so can anyone tell me what the tax implications of that are? No.
No, you honestly, it's your whole situation is individual to yourself. Like, again, that's something that you need to connect with your CPA or your accountant and kind of have that conversation of the flow through and what it looks like specifically for you in the May family trust.
So I have a question then. And these are great questions, Kathy, because they come up all the time since the 2018 Secure Act became what it is today. So in Kathy's scenario, they're leaving it to all their IRAs. They've designated the family trust as the beneficiary of those. Is that putting the 10-year required minimum distribution in place because they did that?
When you put it into the May family trust, it's a trust. It's an entity. It is not an individual. So that's
they just kicked in the 10-year rule.
Right. You have to look at the
Right.
next step on who the beneficiaries of that trust would be, and whether the exception, if it was only a disabled individual, you may be able to stretch it. But again, it's what are the terms of those trusts? If there are
Right.
multiple beneficiaries, only one having the disability exception, then you would get back into that 10-year payout rule. So you have to look to the specific document and the players on that underlying document.
Yeah.
Okay.
So it's
no
okay
easy
to
answer.
direct the IRA to the May Family Trust, as long as within that family trust, the only beneficiary is only beneficiary in this scenario is a special needs trust. And that's going to remove the 10-year required minimum distribution.
Oh my God.
I'm asking if
that's why it's really important to be in touch with like your advisors. So like to talk you through those scenarios. So
I and I have tried to do that, but I honestly feel like everyone's kind of confused by all of this. So
yeah.
And I was at a recent convention in Richmond. Sorry, I didn't drop by to say hi, Kathy. And there was a national speaker whom I reached out to afterwards, and she had already left that firm that she was with, but I'm tracking her down and I'm going to bring her in to present on this topic because she knew what she was talking. I mean, you all know what you're talking about too, but we would have one designated 2-hour-and-a-half presentation on this issue and open it up to, the thousands of questions that pop up because of this.
And that's a good idea, Tia, because she's
Yeah.
specific and a subject matter expert in that particular area.
Yeah.
Right. Because I'm sure there's a lot of planners that know you can name a trust, but they don't understand the downstream effect of doing that and making sure the downstream documents and players are set up properly to stretch.
Right. I like that downstream players.
Because it depends on the language in the trust, because if there's no language in the trust to accept in an IRA and it's just you're dumping the IRA into the trust, you're coming out of the IRA wrapper, now you're creating a taxable event for the trust. I mean, there's so many avenues. There's so that's why it's super important to like understand the language within the trust, the tax consequences of naming the trust, and is there language in there to accept in IRA assets and what happens in step 2, 3, and 4. So lots of scenarios.
And it would be a lot easier if we had someone else after Sam, our son, to leave it too. I mean, right now, I'd be happy to name an specific IRA to his special needs trust. But in the end, I really just don't have a person. So we're a small family.
Right. No, you're not alone in that. And it's just trying to figure out ultimately where would you like to see all the hard-earned assets that you've worked through your life to gather. Once it's done supporting Sam, where would you like that to go?
Right.
And keeping in mind, if there isn't anyone to leave and we can't meet the look through, then make sure you have someone that's going to address very quickly, stretching it at least over a 10-year period. So you can minimize the tax impact over a 10-year period instead of taking it in one lump sum in year 10. So being able to look at that scenario as well. And of course, keep in mind any tax laws that could change in the next, how many years.
Yeah.
I mean, IRAs have been pretty stable. 2010 was probably one of the bigger changes that we had seen in a long time in relation to IRAs, but it's very possible that more changes could be coming.
Yeah, for sure.
I have a question that I want to piggyback on with this topic too. So we have a lot of families that have multiple children with disabilities, and so they have multiple trusts with us. And generally, they say when child A passes away, what's left in the final remainder amount in their trust would pour into the other sibling or sibling special needs trusts. If I were the grantor funding those two trusts with qualified retirement plans, am I triggering the 10-year required minimum distribution when I name the other child's trust as the final remainder beneficiary when their sibling dies? Do you know what I'm saying? Do you follow that?
Yeah. So you're like, you've broken it out and you're just saying, all right, when this individual with disabilities passes and it goes to the next individual's trust with who has disabilities.
And I funded
Does it trigger
those trusts with qualified retirement accounts.
I don't know. So that's I'd have to do research on that.
And I would assume like if I'm passing and if I have multiple, I would have individual trusts. I wouldn't be leaving to just one up front and then pouring over. I would probably leave 50-50.
Right.
The inherited IRAs would split at that point. So we would, you start getting into that layered, then it gets a little muddy because the IRS doesn't really have clear documents.
Yeah.
As far as like a trust, which theoretically is not a person. Does the tiered exception apply? There's really no document, IRS regulations or rulings to support that.
This is Wes Judah. Just on this topic, because I've been through this process myself, I'm sure others have.
Okay.
But put a link in for the lady who is asking a lot of this, more for FYI than anything. This is from the Special Needs Alliance. It's a pretty recent assessment of the Secure Act, the requirements necessary to be a quote designated beneficiary, which is what I think everybody's talking about. That's the language associated with the stretch provision. So there's, I think, 4 or 5 different, and if you go down to the middle of the article, it'll show you the IRS regulations on how to be a designated beneficiary. One is a spouse, one is a child, and one is a properly drafted accumulation special needs trust, which gives you the stretch. And there's an attorney, I think, for the lady who said maybe there's an expert required, but there was an attorney who wrote this. But it's pretty clear on how to do it, and in terms of at a macro level. But a properly drafted special needs trust definitely gets you the stretch provision, which could be upwards of 30 or 40 years of a stretch. But then it gets, and which is what my question was next, and it doesn't sound like this is the venue for the question, but there's a, you know, is it better to leave an IRA to a special needs trust, or is it better if you have the ability to split assets, is it better to give taxable assets to the special needs trust? Because if you do, you don't end up having to pay taxes on the IRA as you're getting the distributions versus accumulating taxable assets that you get the basis once you deliver the assets, if you're following my question. I don't know if, I think Peter is the financial expert. I don't know if you have it. Yeah, I don't know if you have an opinion on that or not. Some say it's better for the tax deferral. Some say it's worse because you have to pay taxes on the distributions. Some say you should do an IRA to Roth conversion and then use that. I mean, there's a lot of financial elements. I'm not sure if you guys are able to express any of that. So I'll stop there.
I'll start.
Okay.
Since I was referenced. But the tax experts, that person named Linda Hall in my upper left-hand corner. But so there's no right answer, right? I don't like it depends, but there is really no right. I mean, converting an IRA to a Roth really does depend on the financial, situation. I know the general rule is you don't fund the taxes on the conversion with proceeds from the IRA. You have some other monies somewhere else to fund the taxes. Personally, I think tax deferral is always a good thing, especially the way things are looking. Personally, for me, I'm going to be in a lower tax bracket when I retire than when I'm paying now. So I'd rather pay less taxes later. But it does become a personal decision. If you can do both, a Roth and an IRA, some people do that. It really comes down to a personal decision. So there's no right or wrong answer. Sorry that's kind of a punt, But
no, I get that. I mean, some would say if you have time and you have a lot of IRA assets, that the prudent investment strategy would be to annually convert, if you're going to leave it to a trust because of the trust tax rates, that you would convert the IRAs to the Roths on an annual basis, and to the degree possible, minimize tax impact. Give it to a special needs trust and still get the stretch provision, so you kind of get the best of both worlds if you're able to do it. Now, admittedly, the parent, it's probably the parent, is taking the tax hit, but so what, you know?
Yeah, I mean, yeah, and you know, I know when we've talked to our high net worth clients, you know, when they pay the taxes for things that they're going to give to their children, in effect, they're making a gift to them, right? Because they're not having the tax burden go to their kids. So it really does come down to a personal choice. There is no right one answer. But I'm going to stop because Linda may be like chomping at the bit, going, Pete, stop talking, because you don't really know, and I'll let Linda confirm or deny or refute is a better word what I've been saying. Linda.
No, I would agree. It really is an individual decision as far as timing of when you do it. You've got to think about what your tax situation is. You could be doing a conversion in a year where you're in those top rates anyway, equivalent to what the trust would have paid. Then have you really saved? But if you're in a particular situation for one tax year that a Roth conversion makes sense to capture some of the lower tax rates that are currently and you anticipate the rates going up, which many do, then you personally make a decision, and yes, you're going to have to pay that tax outside of the IRA funds. So it really has to be an individual decision as far as when to pull the trigger and if to do that.
There's only one certainty, is no matter what you do, tax is going to be paid. Like, right. So whether or not it's at a Roth, no matter what, they always get their tax money. So it's whether or not it's the conversion, whether or not your bracket becomes lower upon retirement, and then you're paying at a lower interest rate. The trust, their tax brackets are compressed. So whether you're paying that, I mean, it's no matter what, taxes will be paid. It's just how to mitigate it and what's the best approach.
So, yeah, and one last thing, and then I'll leave the commentary to others, but this is for Linda. Okay. Inside the trust itself, with the investments, so there's capital gains, there's dividends, etc. When the trust is being invested in, are capital gains, I read something, and I'm not sure if this is true or not, because you guys know how information is, but are capital gains captured in the trust, or are they able to be distributed to the beneficiary as income? Because I read somewhere that they're captured in the trust and paid at trust tax rates versus being able to be distributed, and effectively the trust pays less taxes. Do you know the answer to that one?
Okay, so we're talking specifically with a third-party trust.
Yes.
Yes, it is an entity of itself, files a 1041. Capital gains are not a component of DNI or distributable net income that potentially could be taxed on a K-1 to the beneficiary. The capital gains and capital losses are retained and taxed at the trust level. Now, the third-party trusts do have a designation as a disability trust and gets an exemption equal to the former personal exemption. I think it was $4,250 last year. It'll probably be bumped up a little for inflation. I don't know what the current one is going to be. So that much of it will be exempt from the tax. The capital gains will be exempt from tax. And then the additional will be taxed at currently the 15-20% rates, the same rates as individuals. But yes, capital gains are trapped within the trust and are not part of the component potentially taxed to the beneficiary.
But the maximum tax rate for the capital gains inside the trust is 20%, just like an individual tax
Correct.
rate.
Yes.
Okay, so is the strategy to minimize capital gains, or doesn't it matter?
Tax reporting is after Pete does his stuff.
Oh, it's Pete's
so I'm going to
problem.
bounce it back to Pete. Yes,
That's
remember,
Pete.
tax
That's
is always a
question.
reporting of what actually happened. We cannot control that. It's what actually happens. Capital gains can come either from the buy and sell of actual securities or mutual funds, which a lot of the pool trusts are invested in. At the end of the year, could distribute a payment. People think of as dividend, but a component of that could be a long-term capital gain dividend that also will get trapped at the trust level as part of the capital gain calculation. So not to throw you under the bus, Pete, but
I didn't realize that.
Throw me under the bus. It's been that kind of year. Go ahead.
Okay, thank you for that. That was very informative.
Okay.
You're welcome. By the way, Wes, I like the fact that you went right directly to Linda. You figured out quick. Wait, Linda's the expert. That was good. That was good.
And then you see what she did to you, Pete?
I know.
You guys must have practiced this.
Oh, it's 34 years of learning. Tax is the messenger. We are not we didn't write the message. We just deliver the message. So,
So T, at this time, there's no more questions in the chat. I know there was a few that may have came in via email at one point earlier in the week. I don't know if you have those in front of you.
I don't, and I forgot. I think I sent them to Linda or Cindy.
I have them. I can, if you give me a second.
Too.
Yep.
Okay.
If you give me 1 second, I will locate them.
Good. Yeah, and Wes was referring to the Special Needs Alliance, with whom we work very closely, in that we refer clients to that group of attorneys. Our pro bono legal counsel is actually one of the Special Needs Alliance people. In the article that you referenced, Wes, gets the funds to the trust. It's all that stuff that happens on the back end that becomes, I find, more complicated now that I finally understand the front end process, but it did take a couple of years. And we do try to post articles on the archivenovatrust.org website under resources whenever new information comes up about the trust and the Secure Act and distributions. It is complicated. It is, and that's why in all of our trust documents, it says professional tax advice is recommended, professional legal advice is recommended. We do know that our trusts have been written to accept, and I'll say properly accept for lack of better terminology, the retirement account plans, the qualified retirement plans. But it
so is. I found the questions. Go ahead, Cindy. Sorry.
No, I was just going to say, so I was able to spend a good chunk of time with Jim Caffrey, who's the incoming president of Special Needs Alliance, when I was at the Stetson conference a few weeks ago. And he's a phenomenal resource and a very bright attorney, and will do well for the Special Needs Alliance. They have great articles, and to the folks on the line, if you go to their website, you can actually sign up for their newsletter and receive it automatically.
Right.
And then Tia is also a phenomenal resource too, with the links that she has on her website.
Thank you. Vince?
So Tia, the questions, I think we may have addressed them. They were from Kathy.
Yes.
And I think the questions were all addressed, unless Kathy, there was something else that we missed.
I just need a name of a good accountant, attorney. And
well, you have a good attorney.
Yeah.
And the accountant, because this is so new, this is my personal opinion again, from the Arc of Northern Virginia, I guess my professional as well, because the Secure Act is so new, relatively speaking, people are still plodding through it. And I'm pretty sure that there have been some recent changes or that are on the table as well that are being looked at for that. So it's hard. I have to agree with you, Kathy, that it's difficult to find someone who is current on the topic and can explain it well and explain it in a way that someone like a layperson like me can actually understand what they're saying.
That's exactly what I feel right now. Like everything's over my head when I hear it. And
you guys had a webinar that I was on a couple weeks ago that you had a tax accountant on from Northern.
Right. With Chris.
Chris, yeah, he was very knowledgeable on this topic.
Yeah.
What's
Yeah.
his name?
Looking for the tax accountant. He may be, and he has a child with special needs.
Right. Chris Frost. He
Yes,
has
and
a child with Down syndrome. Yeah.
Yeah, and he seemed to have a pretty good grasp on all of this. So
Okay.
So that wasn't recorded, Kathy. That's one of those. And thank you, Wes, for that. That was one of those third Fridays that don't get recorded because people may come in with a lot of personal information and questions. But Chris Frost, we can get you his contact. He's on the web. You'll find him if you say, Chris Frost.
Yeah, that's great because maybe I could, start using him.
Yeah.
Yep.
Yeah, he's part of our Down syndrome network up here in Northern Virginia.
Mm-hmm. Joan has a couple of comments. She wanted to thank us all for our expertise, and she let us know that Big John's S&T is helping him and his current needs, and he's thriving with all this help.
Oh, thank you, Joan. I'm glad to hear Big John's doing well. So any more questions right now? Because otherwise we can pop in and come up with some standard questions like, well, we have the real estate tomorrow. So Cindy, I just received an email this morning from one of our grantors that said that they've paid off the condo and they're want to talk to us about putting the condo in the trust. So I know we have a hour and a half presentation tomorrow on the topic, but do you want to speak a few minutes to real estate or real property and trust?
I sure can. So it is a process. So we like to set expectations out very securely around. It just doesn't happen within a day or two. There's a lot of conversation that happens up front. So a lot of conversation around the actual type of real estate that you're looking to put in trust for the benefit of your child or your son or your daughter. And that goes around, are you putting in a 5-bedroom center hall colonial on 10 acres with an in-ground pool, a hot tub, and maybe some kind of farm attached to it? Like, we really look at the home and say, one, is the home really, is it the perfect home and the right home for the individual with disabilities? Is it on a public transportation line? I mean, we look at a lot of different aspects when it comes to the actual home itself, but then we take it to the next level and we say, okay, great. The home is perfect. The child will thrive and remain in the home and be well taken care of. Now, can we afford it? So what are the assets around that particular individual's, trust? So are we looking at a $500,000 home in trust and $20,000 in assets to support it? That's not going to work. We really need to look and say, okay, we'll take in the real estate and we'll help manage it. However, are there enough assets to not only support the individual and their needs, because that's top of priority, that's top of list, is after all the benefits that are received, what are the other expenses that will need to help support the individual? And then we look to the house. Okay, what are the annual expenses of the home? If the mortgage is paid off, that's great. That's what we like to see. What's the real estate taxes, school taxes, the homeowner's insurance, the upkeep and maintenance that is done on an annual basis. Are there people living in the house? There's a lot of questions and conversations that we like to have with the families to kind of lay out the lay of the land when we're talking real estate. So not all pieces of real estate are accepted because some of them, like I said, the real estate is too much and not proper in just, a lot of folks are like, well, this is their family home. So when we're gone, we want them to stay in the family home. Well, it may not be the perfect home for that individual. And the last thing we want to do is have to sell a piece of real estate and then take that individual and put them in a different type of housing scenario that may upset them. So having these plans in place and really looking towards mom and dad's estate plan, essentially, and making sure that it's, when we're looking at real estate, we're really looking at everything that's involved in the real estate, from being financially viable to can we support and maintain the home for the individual? Are they able to manage the home, or do they need help? Are there going to be anybody that living with them? So lots of different questions, lots of conversations. It doesn't happen right out of the gate. So just know when you're looking to add real estate, we definitely want to have some robust conversation.
So is this tomorrow's?
Yes, it is.
Okay, great.
So tomorrow's all about real estate. So
Yay.
grab yourself a big cup of caffeine and come on over.
Maybe a beer.
Yeah. And
For me or you, no.
And if anybody that's watching this video after November 4th, 2022, go back to the website, thearcofnovatrust.org under videos, and we'll have put the real estate presentation, because that will, the first Fridays on real estate, that will be recorded and available to you for your viewing pleasure.
Yeah, January 9th. So January is a real estate officer within Key, and I've been part of the committee for 15 years. So I understand what our capabilities are in the space very, very well. So we'll talk high level on soup to nuts on what it looks like to try to consider putting real estate into a special needs trust.
And it's that question comes up a lot in especially in our region or in the United States with Maryland, DC, and Virginia. There are many grantors that are looking to provide a stable housing situation that is owned by the Special Needs Trust. And KeyBank has all of the national, I don't know what they're called, certifications, licenses, whatever, for property management, right? So
yeah, we have a team. So there's our National Trust Real Estate team has 8 officers, all licensed within different variables of real estate. So a lot of them can manage everything from primary residences to gas, oil, mineral rights, and having the expertise in that land area, particularly when it comes to real estate. But I'll tell you honestly, when we're working with, and I've been working with special needs trusts for 30 years. So typically you're not looking at the crazy different types of real estate. It's more or less the primary residence or a condo or for that individual that they're looking to put into the trust.
Although it can also hold rental properties. I believe we have clients that have rental properties as well.
Yep, that's the other one was I have a commercial piece of property that's a rental. We want the income to flow in, and what does that look like? So we have those conversations as well. And each case is different. So everybody, it's just, there is no 2 scenarios alike. So that's why we like to have the conversations.
Well, and it's also important to have the conversations to make sure that it's a realistic solution.
Mm-hmm.
And it's better to have those conversations up front. When we first started talking about this, and when we asked during the RFP, the response for proposal process, and said to KeyBank, and Cindy was among people from Key that was at the ARC of Northern Virginia that day, will the trust hold real estate? And she said, yeah. And my jaw dropped, the entire foundation board, all of our jaws dropped, because that wasn't a possibility in the past. KeyBank has offered to function as an executor of the estate for some people, and as a successor trustee on family trusts as well. So KeyBank really goes above and beyond, I find, in the realm of a financial institution offering the fiduciary responsibilities and duties. It's just amazing what we've been able to and are able to do with KeyBank. I'm going to ask Linda a question, and then Peter, I'm going to have you talk about investments, the financial, the lay of the land in 2022, and maybe KeyBank's projections. But Linda, first off, can you give us a little, I say little, but we're talking taxes, so it'll probably take longer than just a minute or two. What's the difference with the third-party special needs trust, or what we call family funded, and first-party special needs trust, what we call self-funded, when April rolls around and KeyBank is getting the paperwork ready for those individual trusts? Is that enough question for you to figure out what I'm trying to ask?
Okay, so I think pretty much what does the beneficiary expect to receive for a self-funded versus a family-funded trust.
Right, and how do you look at those trusts too?
Well, self-funded trusts are taxed as the grantor type returns. They are trusts that are established with the individual, the named beneficiaries, assets, awards, whatever they've received in their name. So the trust offers protections to allow them to continue on various programs, but for tax purposes are not viewed as relinquish their ownership. So all of the income, dividends, capital gains activity that occurs within the pool that is allocated to that individual will be reported out on a grantor tax letter. And that grantor tax letter needs to be incorporated in the individual, the beneficiary's 1040 filing. And the trust itself does not pay any tax on any of the income. All of the tax responsibility lies with the beneficiary as part of their 1040. Now, a third-party trust is an actual trust. It taxes as what we call a complex 100 type trust. So there's various steps that we have to go through. We have to first identify all of the income for that tax year that is associated with that trust to calculate what we call DNI and what taxable income. Then we have to look to, did the beneficiary receive any payments from the trust during that calendar year? And then test if I have positive income and they receive distributions, the lesser of the two gets taxed to the beneficiary. The trust pays tax on the remainder plus the capital gains. If the beneficiary received no distributions, then all of the taxable income, dividends, interest, plus the capital gains will be taxed at the trust level. The trust will pay tax, and you will see if the trust actually has a tax liability, you will see an entry on your April statement of the tax that was paid in association with the trust. I know frequently we've been asked, is that a tax payment they can report on their 1040? No, that is the actual tax paid on the liability assessed to the trust itself. That is not for the 1040. The only piece that would be picked up in a third-party trust on their 1040 would be the K1 that they would receive, and that would include any reportable income to them, and that part would be part of their 1040. So hopefully I've kind of covered the differences between the two, the type of documents you're going to receive, and the work that goes on behind the scenes to deliver that tax document to you.
Thank you, Linda. Thank you. Yes, exactly what I was looking for, because it's so much more eloquent when you say it as well.
Linda, this is Wes Judah. If there's income left over after all these calculations that you guys do, in order to shield paying back trust tax, can you distribute the remainder income or some income to an ABLE account? And then does that count as a distribution from the trust, and does that minimize trust income?
If payments have been paid out to the beneficiary to fund an ABLE trust, yes, we treat that as a distribution to the beneficiary. But we look at the distributions that are made during the year, so during 22, to measure how much is taxed out in association with the 22's income. So to look at that after year end, we do not do the look back or
no,
pull back.
I wasn't thinking about that.
Okay.
Just in terms of planning, just if you're keeping up with it, you could distribute money to an ABLE account. And
yes, we treat that as a distribution to that individual who then funds the ABLE trust. Yeah.
Yeah, because ultimately that money is, can be used. There's more things that you can use with ABLE than third-party special needs trusts, and it's a way to lessen trust income, I guess is my point.
So that's a semi-untrue statement.
Is it? Okay.
Yeah, we hear it all the time. So
that's why I was asking, because as you know, in this community, you ask 10 questions and you get 13 answers.
Yeah, exactly. And they're all different. So the special needs trusts have a very broad use of the funds, The big difference is with an ABLE account, and I'm not talking taxation because I know there are tax implications, because that just came up in another seminar the other day. So Linda, you two were talking about the tax implications, but for what they can be used for, The loophole, so to speak, with an ABLE account is if the individual has SSI, supplemental security income. An ABLE account can be used for room and board, and it's not reportable to Social Security, which means that they will not reduce the SSI. Other than that, an ABLE account is to be used for qualified disability expenditures. And we're all waiting with bated breath to see how the IRS is going to look at that when they do audit ABLE accounts, because they did not define qualified disability expenditures beyond 13 categories: transportation, legal fees, basic needs, blah, blah, blah. So, period. And as my sister would say, break, break. She was in the Army. Break, break. So now we're going to talk about the special needs trust. The first party special needs trust is for the primary benefit of the individual. So it can be used for anything. If the person has SSI, we have to inform the person that if we use the trust to pay the rent, they're going to that's reportable to Social Security, and they may reduce the SSI. We're only talking SSI because it's means tested, not SSDI, not anything else. Also, the money could be moved to from the first party to the ABLE. There's a tax implication, but then the ABLE pays the rent and it's not reportable. The SSI doesn't get touched. The third party trust has the most uses of the three vehicles we're talking about right now, because it's not only for the beneficiary's primary benefit, but it can also be used to buy gifts. An ABLE account is not for gifts for other people. It's not for charitable contributions. It's not for political contributions. It's for the primary benefit of the individual. The first party trust is for the primary benefit of the individual. The third party is beyond the primary benefit of the individual. It may be used to gift holiday presents, birthday presents, taking mom and dad out to dinner, or your boyfriend or girlfriend, as long as that's how the grantor wanted the funds to be spent. So the third party trust is really the primary number one tool I think you want to have, because it can also accept money from $10 to $10 gazillion, right? The special needs trust has no limits on how much may be contributed to it. And so that's what I'm referring to, Wes, is that there's a very broad use of that. And I know there are people out there saying that the trusts don't have the same use, but they're just as broad, if not broader. There may be implications if SSI is there. Most people that have third-party special needs trusts, they're oftentimes funded upon the death of the first or second parent. And so by that point, even before the death of the parents, the individual has probably switched from supplemental security income, which is means tested, to Social Security disability, because they're able to piggyback on their parents' Social Security payments. So then the SSI rules fall away completely, and we don't have to worry about can it pay rent or food, because it can if the person has SSDI. So that was a very long speech on that one simple sentence that you made, because it's a myth and it comes up all the time. And there are some ABLE representatives, meaning capital ABLE representatives, that understand the difference between trusts, and there are some that don't, just as there are attorneys that understand special needs trusts and their uses and the differences between them and ABLE, and then some that don't, right? It's a question of how in depth they've researched it. So I'll stop talking.
Appreciate that answer. That was enlightening. Thank you.
You're welcome. You're welcome. Yeah, because the ABLE is a good tool. It has those financial limitations as well, but it does have the tax benefits. So, it really is. And I never heard this phrase until I started working at the Arc of Northern Virginia 16, 17 odd years ago. It's another tool in the toolbox. Whatever we can put in place for our kids with disabilities that's going to work for them, that's what we want to be doing. I have not. I have two daughters with disabilities. They're now 22 and 28, or 23, excuse me. It was Sky's birthday yesterday, 23 and 28. I have not established ABLE accounts for them just because I cannot oversee another account. At my age, I'm trying to delegate the work, and I'm three years into my 10-year plan of having everything in place for them, so that by the time I won't be working anymore, and I'll know that other people have stepped in, and I'll see that things are working for them, and I can actually sit back and maybe start traveling again and having my own life. So it's just super important the older we get to really look at what we can have in place for our children, whatever their age, and make sure we have people that we trust to come in and take over for us when we no longer are able to do that. Peter, what's new in the world of finance this year?
Well, first, let me say we're all lucky that this is on recording. So if you have any questions on what Linda said, and I don't know why you would, but if you did, you can actually listen to this 100 times and maybe figure it out. But that stuff is very complicated, Linda. You do a phenomenal job. So it's been a rough year, as we all know, for the markets. Prior to 2022, the hallmark of investment management was, you had equities, you had fixed income / bonds, and if one went up, the other went down, and, there was some stability, and they kind of went in different directions, and that provided stability, but over time it would grow. This year, that is definitely not the case. Everything is down, and that's the result of obviously inflation and the Fed, and I'm oversimplifying this, but the Fed Reserve raising interest rates. On my last count, and Vince, you can correct me if I'm wrong, I believe now we're up to 3.75% that the Fed has raised interest rates in 2022. To put that in perspective, approximately 1 year ago, the same Federal Reserve chairman said, we're not raising interest rates in 2022. So not only has it's been a rocket of raising rates, and that's had a negative effect on stocks, especially the way stocks are valued by whatever. We're not going to get technical, but the high growth stocks, Meta, NVIDIA, Apple, Google, those really high price stocks that are still making ungodly amounts of money, but the price that people are willing to pay for those stocks have come down. The second thing is with interest rates going up, the price of bonds go in the opposite direction. So those safe investments, i.e. bonds, have also lost. To put in perspective, I have statistics for everyone. Year to date, and this is as of 10/31, the aggregate bond index, that's basically the entire universe of the U.S. Non-high yield bond world, is down 16%. These numbers are...
Sorry, Peter, 10/31/2022.
Thank you. Yes. Is down 16%. And the S&P as of 10/31/2022 is down 17%, almost 18%. So the balanced portfolios, everything's has been hit. And we have in our portfolios made some adjustments that have worked, relatively speaking, right? We've reduced our exposure in equities. We've put some non-correlated assets, meaning that's what bonds and equities used to be, non-correlated. If one went up, the other went down. But as I can tell you, as I just told you, they are correlated, and unfortunately, they correlated down. So we've put in some non-correlated assets that have done okay. They haven't lost nearly that much money as bonds and equities. And we've put in some investments that until recently we thought did well in an inflationary environment, but we've made some changes to that as well because of what's going on. So that's the past, right? What do we see, going forward? Tough, Jerome Powell said it yesterday. Don't get fooled, right? They're going to keep the pedal to the metal. They think inflation is the number one thing that they have to stamp out, that unemployment is very low, so they feel they have room. Will they go in December to another 75 basis points? I think the way it sounded yesterday, they're going to be much more data dependent than just an automatic 75. So that was the initial, when yesterday at 2 o'clock it came out and the statement, a lot of the market participants looked at that and said, "Oh boy, he's going to, they may pivot." That's the new word. They may slow down, or they may, stop, or they may actually reduce interest rates. And then Chairman Powell spoke, and he squashed any of that. That they're going to eliminate as best as they can inflation. He makes it very clear it's not only good for the United States, it's good for the world. And there's a lot of stuff that goes along with the Federal Reserve raising interest rates. Our dollar becomes stronger. That has implications. So today, I think it was the central bank in England, I believe, raised their rate 75 basis points. So there's a little bit more coordination in terms of squashing inflation. And we're just going to have to see what 2023 brings. We are seeing some signs of inflation having peaked and maybe rolling over. We feel that housing's in a recession already. No one's going to move from their house or very few people are going to move. I shouldn't say no one. Very few people are going to move from a house that's paying 2% interest and buy a house and pay 7% interest. And the housing industry, it is a big part of our overall economics. So that basically is, if not in a recession, is pretty close. And that filters through. What Chairman Powell said yesterday too is, and everyone's been saying this, but it's the first time he said it, these rates take time to completely filter through the economy. So that's why while they'll probably raise rates in December, they may not raise it 75 basis points. But that's going to be the next sort of game here. What are they going to do? Is it going to be 50? It's going to be 75, and they'll be relying on the data. So as of now, we haven't really come out with our key private banks, forecast for 2023. What are we watching? We're watching earnings in the S&P 500, right? The estimates by everybody's estimations are coming down. So that has, implications to the stock market. What you pay for that earnings, that multiple right now is actually steady, but if that goes down, that's not going to help the stock market, right? But if it goes up, it could help. So we think, believe it or not, that there's actually income finally to be made in fixed income. When you can get 4 and 5% now, that's not a bad thing to have in your portfolio. So we are looking at maybe making some macro changes to our portfolios in terms of maybe adding a little bit more to fixed income and maybe rebalancing between large and small cap. We haven't set, even during this, I give our investment center a lot of credit. Earlier, maybe late 2021, we actually reduced our exposure to equities in late 2021, saying, wait, inflation's running hot. They're going to have to raise rates. This is going to have negative implications, and we've reduced it. And that's been a good call, relatively speaking. What calls we'll make going forward, you know, they haven't communicated to us yet. I would say this is a very tough time. I know if you get statements and you look at it, you go, wow, you know, it's down. Markets go down. They don't always go up. And I think, generally speaking, market participants got very, what's the word I'm looking for? Complacent. I was going to say lethargic. That's not the word. Complacent in thinking that their investment accounts were savings accounts, that they only went up. And investment accounts are not savings accounts. Investment accounts are investment accounts, and investment accounts can and have gone down. We don't recommend, unless you know, generally speaking, and everyone this is like taxes, right? Generally speaking, you have to look at your own, you know, cash needs and stuff, you know, what liquidity needs, but we don't recommend completely selling out of the market. We think this will correct, and over the long term, having a mixture of stocks and bonds is probably beneficial to you as an investor. I will stop there and
thank you, Peter. That was excellent. Thank you. Tell me,
you're welcome.
One quick thing again, and I always use the word quick, I've noticed, but it's never quick. What is it? So the portfolios that KeyBank offers the grantors with the assets that are in the special needs trust. Can you just give me a brief, or give us all a brief overview of the types of portfolios that are offered?
Sure. So we can have a mixture of, you know, well, you can have all equities, right? And equities, what I mean by equities is, generally speaking, I'm not going to get into, you know, customer stuff like that. The equities consist of mutual funds and exchange traded funds or called ETFs, right? And allow me just one thing to say, my teammates and I are not commission-based employees. We're salary-based. We don't make any money from using a specific investment in your portfolios. So there's no front end or back end loads. We don't get any incentive to use I work with our investment center, and they come up with what they think is the combination of funds to use for your portfolios. So in the fixed income, same thing. We use bond funds, okay? And we monitor these funds all the time. We're not just set it and forget it. Not only do we change the amount that are in there, but we make sure these managers are saying what they're investing, what they say they're going to. If they're going to be a large cap manager, we want to make sure they're investing in large cap. If they're a small cap manager, because if they drift, that could cause adding unwanted volatility in your portfolio. So to get back to, though, Tia's question, thank you for that sidebar there, Tia. We can have all fixed income, we can have all equities, and then you can have anything in between, a combination of, you know, it tilts more towards equities, and we call that growth/income. We can have it tilt more towards fixed income, and we call that income/growth. And then we can have something in between, and the creative people that we call that balanced. So and the investments don't change with the objective. It's just how much of those investments we have in your portfolio. We use institutional class. If we're using mutual funds, we use institutional class, so they're the lowest fee for that fund family. I'm trying to think of anything else. I mentioned we don't get any commissions or anything like that. I think that addresses everything. But yeah. Cindy or Vince, if I missed something important, by all means, step in. But I think I got everything.
You did.
Yeah,
Good job, Pete.
yeah.
Okay.
And I like that you mentioned that, because that does come up in the consultations. The fact that you're salary based and there are no front or back end loads is really important, because when people are trying to determine, do we want to go with the Arc of Northern Virginia and KeyBank, or do we want to have a private trust, as I call it, and have a financial planner investing? And then, you know, they look at having a CPA then as well, and they're outsourcing to those different individuals. And we recommend to them, you know, you really have to sit down and figure out what's best for you, obviously, and who do you want managing your money? Because there are fees associated with the Arc of Northern Virginia and KeyBank doing the work that we do, and they're competitive fees. And KeyBank has lowered their fees 2 or 3 times over the last 2 or 3 years. I've lost track with the pandemic. I can't even, you know, remember what I had for breakfast yesterday, but I know that that's been a, you know, we discuss that regularly. And it's important to decide who you want managing the money, realizing many times whenever it's an individual that is the successor trustee and is managing the trust when you're deceased, that they may be outsourcing and paying fees to these other individuals that are doing the work that we together with KeyBank do. So that's usually not what people get stuck on, you know, what are the fees? But they do ask about that front end, back end. And the fact that KeyBank offers a selection of portfolios from which to choose is super important, because it's not just this, that, or the other thing. There are 7 portfolios and then the cash option, and you can change those. Again, we always recommend not doing that frequently, obviously, because that has a cost to it. But you know, you have the ability to speak with KeyBank and Peter in particular about the different investments offered, And then for those of you that don't know, the Arc of Northern Virginia has a separate nonprofit called the Foundation of the Arc of Northern Virginia that oversees the endowment and the Special Needs Trust Fund. And on a monthly basis, Peter, KeyBank, provides a report, a 30-some page monthly report on investments, and our investments in particular as well. And then every other month, the foundation, unless there's something going on, like this year it was more frequent, we had more frequent meetings because of what was happening in the investments in the stock market and whatnot. But otherwise, every other month we meet, and Peter and Vince and Cindy, depending on what we're talking about, but definitely Peter is there, and sometimes Vince and sometimes Cindy, about the investments and how in that active management, and our board members who are well-versed in investments as well as law, they pose questions to Peter, who has an answer. And if he doesn't, he goes back and gets one. So I just want to reiterate the wonderful collaboration we have with you, KeyBank. You have been, I'm always so proud of the choice that we made back in the day, because what KeyBank offers us is phenomenal, and they are proactive and as well as responsive. And that's super important when you're working with people's money, right? And their means and their lives in the long run, making sure that the assets are being handled as well as we'd all like our own money to be handled. So I want to
thank you, Tia. We appreciate that.
You're welcome. And I want to thank you all for joining this morning. We have an evening session tonight at 7 p.m. And so take a rest and rest your brains. And attendees, thank you for attending. And we'll be able to post this up on the web at some point so that other people can view it as well. So thank you, everyone. Have a lovely rest of the day, and I'll see some of you.
Thank you all. Thank you.
Thank you, everybody.
Thanks, Tia.
Thank you.